Alrighty. So, what is the most beginner-friendly option trading strategy? Well, in my humble opinion, that is none other than the put ratio spread. But it has to be traded on the cash-settled index options such as the MRAT, the XSP, the SPX, the NDX, and the RUT. So what are all this? Well, basically this is the mini Russell 2000 index, this is the mini S&P 500 index, this is the S&P full-size index options, this is the Nasdaq, and this is the Russell. So why do I say that the put ratio spread on the cash settled index options are the most beginner friendly option trading strategy? Well, it's simply because it is a very simple strategy to execute when you put them on the cash settled index options. Remember, it has to be on the cash settled index options and not the individual stocks or index ETFs, right? So the strategy is simple to execute. Well, all you have to do is place the put ratio spread and you're basically done, right? You just leave it to expiration. There's no need to manage trades and there is no risk of early assignment, right? So at expiration, because this is a cash settled index option, basically the settlement will be in cash regardless of a win or a loss, right? So basically it's like, if you just roll the bowling ball, right, your job is done. All you have to see is the results, right? It's either you hit all the pins down or you hit some or you miss. So in the same way, when you put the put ratio spread on cash settled index options, it is pretty much this way. All you have to do, put on the put ratio spread. This is pretty much the most planning, most thinking that you have to do. But once you've done that, everything else is done, right? Just leave it to expiration. No need to manage it because of the nature of how we're going to do this strategy, and there's no risk of early assignment, there's no settlement of shares or ETF because all this is cash settled. Alright, so I'm going to go into the details of the put ratio spread. So if you don't already know, this is the risk profile of a put ratio spread. So first thing, as you can see, the put ratio spread is actually a very high win rate kind of strategy, right? You can see that the win rate can be 80 to 90% depending on how you construct it, right? But the thing with the put ratio spread is that in order for you to get the max profit, you really have to just hit this part of the tent, right? So you can see this part, it looks like a tent. So in order for you to really achieve the most out of this, the price have to settle around here during expiration, right? And especially put ratio spread is a very slow spread, which means to say when you want to achieve this max profit down here, you pretty much have to hold it all the way to expiration, right? So the put ratio spread will be managed very much differently compared to other types of strategies, different other types of option strategies. So if the market was to just trade anywhere above here, all you do is, all you'll be getting is just the credit, right? And that's not that much. So for you to actually pin this short strike down here to actually achieve this max profit, as you can see, it's not that easy, but I managed to do so on one of the trades which I put on. Right, so this is on the MRAT, which is the Russell 2000 index options, right? This is the mini one. So on this day down here, which is on the 10th February, right, as the market come down, I put on a put ratio spread. So you can see I put on the put ratio spread with the 185, 180 strikes. So this is where you have the long put and this is where you have the two short strikes, right? So how do you see what is the profit down here? So what I did is I overlaid the profit zones so you can easily see, right, where you actually can get the profits. So basically anything that is above here, right, above this blue line down here, which is the long put strike, all you'll be doing is you'll be receiving this credit, right? So I sold this for $1.27, so that is $127 for this put ratio spread. So anywhere that it settles here at expiration, right, anywhere above this blue line, it'll be just $127. But once it enters below this blue line down here, this is where your tent is, right? So if you recall, this is the tent down here. So basically this is the profit zone, right, where you'll be entering the chance for you to get this max profit zone. So basically is down here, and below here, this is where your loss will start to occur, right? Because as the put ratio spread, right, as the market goes lower, the put ratio spread will reach a point where it will get into a loss if it settles there at expiration. So as you can see, the market, right after that just went back and forth until finally it went all the way down, mainly because of the SVB crisis, right, the Silicon Valley Bank, which have crashed. So because of that, right, IWM also got affected. Right, a lot of the index got affected, but the IWM got affected a little bit more than the other index ETFs. So as you can see, it went down and it briefly went into the negative territory before coming back up, and then it expired at the short strike for maximum profit, right? So as you can see, it expires on the 31st of March, right, as you can see down here. So which means to say anything that is before that, you don't really have to do anything, right? Because what we're going to do is basically just put on the trade at entry and then hold it all the way to expiration, because this is how the trade is being set up. Right, so even though as it goes down into the negative zone, there's nothing for you to worry, right? Because you already have your risk plan out. You know what's your max risk going to be. If it hits the max risk, which is your buying power effect, you want to get out. But if it doesn't, then all you have to do is just wait until it finally, right, settles at expiration, and you see what is the profit and loss. So as you can see down here, this is where I managed to hit the max profit. So before I get into the strategy, I want to share with you a little bit why the put ratio spread is a very good strategy for you to use, especially if you do not really have any directional view as well. So first of all, it is a very high probability of profit. That means you have a very high win rate, usually more than 80%. It's omnidirectional as well. That means you can profit in all directions, right? As you can see, I put it on down here, right? The market proceeded to trade down, and I still made a lot more money than if the market was higher, right? Because of the way the put ratio spread is being set up. So it can go down, go up, and you still can profit, right? Next, you have very versatile construction. So as I mentioned before, you can either make it slightly more bullish or bearish depending on your outlook, right? So for example, this 10 down here, if you're slightly more bullish, what you could do is could shift the tent, right? The tent could be shifted down here, and then this is how your put ratio spread will look like, right? So if you're a little bit more bearish, then you could adjust this so that the tent goes further back, right? So if the tent goes further back, you will receive lesser credit upfront, but you will make much more at the back if the market really goes down. So that is why it is very versatile, and it's really up to you to just play around with the construction to see, you know, which one you prefer. Next, you have the potential to make more if the market goes down. So as you can see, the market goes down, and that's where I achieved the max profit, because it entered into the tent, right, the profit zone. And it's also a semi-hedge against long positions, right? So I say this as a semi-hedge because as the market goes further down past the break-even point of the put ratio spread, that's when you start to lose money. So it's not a real perfect hedge, you know, compared to maybe like a long put option, whereas the market goes further down, then that's where your option will make more, right? So a semi-hedge is because you may have some bullish positions on. So in this case, if the market goes down, you actually can have a chance to, you know, make much more than if the market goes up based on this position. So it's a semi-hedge, right? And there's very little management involved. So that's one of the reasons why I like it, because I do not trade very long hours. In fact, I only trade about 1 to 2 hours each trading day. And then for the put ratio spread, you can just simply put it on, wait until expiration, and then see, you know, what's the final outcome, right, of this trade. So if you are someone that's very busy, you don't have a lot of time to stare at the charts, then the put ratio spread is a very good strategy for you. Alright, next, so how do you hit the max profit with the put ratio spread? By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. Alright, back to the video. And the answer is strategy plus a little bit of luck, right? Because you do need a little bit of luck for you to pin that short strike at expiration, right? For other than that, for the most part, it can be designed by strategy. So how do you do that by strategy? Now, I'm not too sure whether you've played this game when you are growing up, but basically, you know, this is like what you call a ring toss, right? So basically, you have the cone down here, and then you would try to use this ring to try and, you know, toss it into the cone, right? Hopefully that, you know, it will get into the cone. So you can see from here that it requires, you know, quite a bit of skill, and it's a little bit difficult for you to get into this cone if there's just one cone. Now, what if you compare this to having many cones, right? Instead of just one cone, now you have many cones for you to throw the ring to, right? So this case, let's say for example, if you're aiming for the orange cone, if you throw it and so happens that it went a little bit further than the orange cone, you may not hit the orange cone, but you may actually hit the yellow cone. So you could actually, get the ring into the yellow cone. And let's say, for example, if you throw it, somehow it swerved a little bit to the right, you threw it a little bit wrongly. Guess what? Although you missed this, you'll be able to maybe get into the blue cone, the yellow cone, or even the green cone. So what is all this cones about? So basically, this is the strategy with the put ratio spread as well. So for most people, right, when they put on the put ratio spread, they will just put one put ratio spread down here and then just see, whether it expires in this zone, right? This cone down here, whether it expires in this zone by expiration. If it doesn't, they put on another one. So when you do it this way, it's a little bit of a hit and miss because you only have one. But if you have multiple put ratio spreads, right, where you have multiple, profit zones, then guess what? The market may miss one, but it could hit the other ones. So this way, you may not necessarily make a lot of money on this one, maybe just receive the credit, but you could receive, quite a bit more on the next profit zone, and so on and so forth, right? So of course, if you're just starting out, you definitely want to just start off with one, but as you get a little bit more experience, then this strategy is going to help you increase the chances of you hitting the max profit zone, right? Increase the chances of you actually pinning the strike. So the strategy down here is to have multiple put ratio spreads for multiple profit zones with, this is the very important part, which is different entry timing. You want to enter them at very different times. You want to enter them with different strike price, and you also want to enter them with different days to expiration, so they all mature at different times, and you want to have different risk profile for all of them, right? So some may be slightly bullish, some may be slightly more bearish. So this way you have a very good mix of different put ratio spreads, and you have multiple profit zones across the charts, right? So this way it really helps you increase the chances of you actually landing into the profit zone to hit the max profit. Now, when you put on this strategy, what's important is risk management, right? So a lot of people have questioned, if you put on multiple put ratio spread, is it going to be risky? What are the risks involved? So this is a very important point, and I want to get into it. So I want to share with you the difference between what is called the vertical diversification versus the horizontal diversification. So for the most part, most people are doing what you call horizontal diversification, which basically is you're putting into many different stocks, and then you just enter positions on it, right? So for example, most of the time, when people open up their trading platforms, they will have a watch list of different stocks, right? So they will go to their stock A and they see that, all right, there is a potential setup for a put ratio spread. Then they put on the put ratio spread. Then they open up stock B, all right. The chart also says that, I could put on a put ratio spread as well, and it's so on and so forth for the other stocks as well. So they will have maybe 4 put ratio spreads on 4 different stocks. So this is what you call horizontal diversification. Now the problem with this is that when you enter on the same day, right, or roughly basically the same time within a few days apart, when the market crashes, guess what? All these stocks will all crash at the same time as well, as you have seen during the pandemic, and you have seen during the 2022 crash as well, when the Fed starts to raise the interest rates. Because pretty much if you are in equities, then most of them will be affected, even though they may be in different sectors, right? Some sectors will be affected more than the other, but for the most part, they will all crash in tandem, right? So that is the problem, because if you have to have the positions all at the same time, then they're all going to take a hit at the same time. Now, of course, if you were to do diversification in terms of different asset classes, then you'll be all right, right? Different asset classes, maybe for example, into commodities like gold, silver, and then also in bonds, then you'll be probably fine in that case. But for the most part, most people tend to diversify, only across different equities, and that's not real much of a diversification when the market crashes. Now, on the other hand, what you have is vertical diversification. Now, vertical diversification is based on the same chart, right, or rather the same index ETF for the most part, right? Index ETF we will want to go for instead of individual stocks, because index ETF is a basket of stocks, right? So inherently, it already have some sort of diversification. So let's say, for example, in terms of index ETFs, right? Or in this case, we do the index options, where you can hold all the way to maturity without any risk of assignment. Basically, as the price moves all over the place, right, you can have different profit zones, right? You have a profit zone down here, profit zone down here, profit zone down here, profit zone down here, profit zone down here. So as the market moves, you will have different catchment areas at different points in time, right? So sometimes, like for example, if the market comes down here, you may miss one at the bottom, but you may catch one at the top, right? So in this case, you have much more diversification, especially if the market crashes, because as it goes down, you will have more profit areas even below where the market is. So this way, you always have a chance for you to profit regardless where the market goes to. So this is something that's very important. The next thing to take note of, right, is that you need to treat each put ratio spread as an individual trade, right? That means to say, for example, down here, if you were to put 3% on for each of this trade, then it's going to be the same thing down here, right? For each one, you're going to put just 3% of your risk, 3%, 3%, and all this all 3%. And you definitely want to manage each one individually rather than as though they are all one big trade, right? You want to manage them all individually because they all have their own probability of profit, their own win rate, their own different risk profile. So in this case, you're actually managing, let's say for example, there are 5 put ratio spreads here. You're managing 5 different put ratio spread instead of just thinking of that all this is just one, right? And last but not least, of course, you want to reach no more than 3 to 5% on any single put ratio spread. So this way, you are managing it well. So what I'll do right now is I want to head on over to my trading platform to share with you a little bit more of how this strategy actually works. Alright, so this is one of my trading accounts, right? So as you can see down here, I have multiple put ratio spreads on down here, right? You can see that's all across different strike prices, different days to expiration. They're all entered at different time down here. So as you can see down here, you have a very blended kind of P&L, right? But at this point, mostly are in a profit because as you can see, as the market moves, I'll be always putting put ratio spreads. Some would have already expired and some would be still on as well. So the most important thing down here is that your buying power effect is essentially your max risk. So this is the max risk that you need to be very comfortable with, knowing that if all of this put ratio spread for some reason, right, goes into a max loss, this will be the most that you lose. So this has to be a certain percentage of your account, not a big percentage, but a very small percentage that you are comfortable with. So this is how you will put the put ratio spread. So there'll be many different profit zones, many different profit areas. So this way, as the market moves, you will always have a chance to hit that, profit zone that tend to pin the short strike to get the max profit out of your put ratio spread. So at the same time, you also do want to have many different strategies. So as you can see down here, I have different types of strategies down here. Mix across, you have strangles, right? Strangles, as you can see, is doing pretty well. I have a short put, covered calls, and as well some long-term positions in leap options as well. So when you do it this way, as the market moves, some will make money, some will lose money, which is all part and parcel of trading options, right? So at the end of the day, you at least have a smoother P&L volatility compared to if you were to put all of them at around the same time. Alright guys, so this is the put ratio spread strategy. If you're just first starting out, of course, just put on one put ratio spread at a time. Once it's expired, then you put on another one. But once you get a little bit more experience, then you can start to put a little bit more on. Most importantly, always make sure that your risk is in check. By the way, if you like this video, then you're absolutely going to love this next video which I have for you. So go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen and you'll be able to get it for free. Alright, I will see you in the next video.